People can start joining. Hello, everyone. Thank you for joining. We're just going to give it another 2 minutes and allow more people to join before we start. Again, thank you all for joining. We're going to start in a couple of minutes. Just going to let, or 1 minute rather, let more people join. Again, for all of those that have joined us, we are going to be starting in just a minute, waiting for more people to come on, and then we'll begin. Okay, we're sitting right at 3 p.m., so probably at 3 p.m. Eastern. Sounds like a good time to start. For all of you who have joined us, thank you. I have the pleasure here of introducing Mark Cantridge. For those of you that have been at our prior webinars, you probably already know the spiel on Mark, but just to repeat for our new visitors, Mark here is the expert when it comes to student loans. So, I mean, he's testified in front of Congress about it. He writes articles for Forbes. You know, he's quoted in the Wall Street Journal about it. Any expert that you know about student loans probably refers to Mark as the expert of the experts. So any question you have about refinancing, nuances, particular situations, have at it. We're going to start with a presentation that's going to be around 30 to 45 minutes, and then we're going to have a Q&A session where, again, try to stump the expert here. This is what, 10th webinar with Mark. I've yet to see a question he doesn't have a very thorough answer to. So have at it. And Mark, I'll let you start off.
Thank you, Julian. So this webinar is about how to refinance a student loan. We've had a series of webinars about borrowing, repaying, loan forgiveness, and this one is about refinancing. And this is a repeat of the previous webinar on the same topic. So there are two different methods of refinancing a student loan. One's called consolidation, the other is called refinance. The term consolidation refers to federal loans, while the term refinancing refers to private student loans. Consolidation and refinance both combine multiple loans into a single loan. The difference is in the interest rate. The interest rate on a federal consolidation loan is based on the weighted average of the interest rates on the old loans, rounded up to the nearest 1/8 of a percentage point, which is a multiple of 0.125%. The interest rate on a private refinance is based on the current credit scores of the borrower and cosigner, if any. This will yield a better interest rate if your credit scores have improved. But generally, credit scores are lower soon after you graduate because your credit utilization increases each year in school. You have more debt, a higher debt to income ratio. Your credit scores will be lowest at that point in time, and it takes several years of managing your credit responsibly for your credit score to improve. And managing your credits responsibly means you have to pay all of your bills on time, not just the student loans, and that means by the due date. You also need to have a steady job for at least 2 years because the lenders will be concerned about maybe you're going to lose your job. You don't keep jobs very long, and that'll affect your ability to repay the debt. So the tendency of recent college graduates to switch jobs after a year or so makes it difficult to qualify for refinance. Now, only federal loans can be included in a federal direct consolidation loan. If you want to refinance federal and private student loans together, your only option is a private refinance. The interest rates on federal consolidation loans are fixed, whereas private student loans can offer you a choice of fixed or variable interest rates. Right around now, you should prefer fixed rates because interest rates are at or near historic lows, unless you're planning on paying off the debt in full within just a few years before the variable interest rates rise too much. Now, the fixed interest rate that you're offered on a private refinance may depend on the length of the repayment term, with interest rates shorter on a shorter repayment term. Essentially, the lenders are modeling where their cost of funds will head, and which is always going to be a variable rate. And so if interest rates have nowhere to go but up, the longer the term of the loan, the higher the average interest rate. And therefore, that's why they offer a higher fixed interest rate for a longer term loan. So I talked about how the interest rate on a federal consolidation loan is based on the weighted average. And what this does is it multiplies each loan interest rate by the loan balance and then sums the total and calculates an average. So each loan's interest rate contributes the weighted average in proportion to the loan's percentage of the total debt. Now, this is an example that shows you with two loans, one involving $5,500, the other $6,500, at two recent interest rates on federal student loans. You multiply each loan balance by the interest rate, you add the products together, you divide the sum by the total debt, and that yields a raw interest rate of around 3.56%. Then we round the result up to the nearest 1/8 of a point, which is 3.625%. This rounding up of the interest rate to the nearest 1/8 of a point increases the interest rate slightly, typically by about 6 basis points, which is 6/100ths of a percent, 0.06%. It doesn't have a really big impact on the cost of the loan. Now let's talk about the impact of the weighted average. So the weighted average yields a new loan with a new interest rate that is lower than the highest interest rate, but it's also higher than the lowest interest rate. So if someone talks about how the federal consolidation loan will reduce the interest rates on your loans, that's not entirely accurate. When you're calculating the weighted average, you'll notice that the weighted average tends to be closer to the interest rates on the loans that have the greater loan balance, because the greater the loan balance, the more impact it has on the overall weighted average. And in general, it preserves the cost of the loan, and we'll give an example that illustrates this. And since the interest rate is based on the weighted average, the cost of the loan really isn't going to change by much. It's not going to save you money. In fact, because of the rounding up, it's going to cost you a little bit more money. The only way to save interest on a federal loan is to choose a shorter repayment term, which yields a higher monthly payment that pays off the debt quicker, and therefore there's less time for interest to accrue. So let's talk about how the weighted average affects the cost of the loan. So we're going to use the same two loans that were in the previous example. And if we look at the loan payments before consolidation versus after consolidation, you can see that there's a difference of 27 cents a month and $32, $33 in total payments over the life of the loan. That's not a really big difference when we're talking about $12,000 in debt. And the rounding up of the interest rate to the nearest 1/8 of a point increases the cost very slightly. Without that rounding, the difference would be not 27 cents, but 7 cents per month. And instead of $33 in total payments, it would be about $8 in total payments. Now, I chose this example specifically to have monthly payments that are greater than $50 a month because federal loans have a $50 minimum payment. So if the calculated payment is less than 50, it'll get rounded up. And so one thing that consolidation does is to reduce the total monthly payments by eliminating this rounding up, because you combine two loans, each of which were rounded up, the total is above that $50 threshold. It's going to yield total monthly payments that are a little bit lower. And that will increase the repayment term a bit and the total payments a bit. But I wanted to focus really on the fundamental impact of the weighted average on the cost of the loans. So why should you consolidate? One of the reasons why people consolidate is to change the repayment term. A longer repayment term will reduce your monthly loan payments, but increase the total interest that you pay over the life of the loan. So it makes it easier on your budget, but you pay for it. On the other hand, a shorter repayment term is going to yield a higher monthly payment, which will pay down your debt quicker and reduce the total interest you pay over the life of the loan. That's going to save you a bit of money. And you should choose the repayment term that has the highest monthly payment you can afford. That'll save you the most money on interest. Now, extended repayment on a federal consolidation loan can provide a 10, 12, 15, 20, 25, or 30-year repayment term, depending on the amount of debt. Without consolidation, you have only one option, which is a 25-year term with $30,000 in debt. With consolidation, you can get a 20-year term on $20,000 of debt, a 25-year term on $40,000 of debt, and a 30-year term on $60,000 or more of debt. Now, there are other repayment plans besides standard and extended repayment. One of the more popular repayment plans is income-driven repayment, which is only available to borrowers whose loans are in the direct loan program. Borrowers in the federal program can consolidate their loans into the direct loan program to qualify. And the federal Parent Plus loans and the federal Perkins loans are not directly eligible for income-driven repayment. But if they are consolidated into a federal direct consolidation loan, the consolidation loan is eligible for an income-driven repayment plan. For example, federal Parent Plus loans that entered repayment on or after July 1 of 2006 are eligible for income contingent repayment if they are included in a federal direct consolidation loan. They are not eligible for any of the other income-driven repayment plans. A consolidation loan that includes a federal Perkins loan may be eligible for any of the income-driven repayment plans. Another reason why people sometimes consolidate is to change the loan servicer. When you consolidate your loans, you do have the option of choosing the servicer on your loans, but you can't choose the servicer on your other loans like the Stafford and Plus loans. A consolidation loan replaces multiple loans with a single loan. This simplifies the repayment process. Now, normally they send you one bill anyway, so it's called unified billing. So it's not as though you're making multiple payments a month, but for some people, just having a single loan with a single monthly payment makes things simpler for them. Now, if your loans are in the Federal Family Education Loan Program, they are not eligible for public service loan forgiveness, but if you consolidate them into the direct loan program, they are. So that's another reason why people sometimes consolidate. There are two methods of rehabilitating defaulted federal loans. One involves making 9 out of 10 consecutive, full, voluntary, reasonable, and affordable monthly loan payments. At the end of that period, the loans are rehabilitated and the default is removed. Somewhat easier process is to consolidate into a federal direct consolidation loan, and this will come with a requirement that you repay the loans under the income-driven repayment plan. And in addition, when you consolidate a loan, it's a new loan. And as a new loan, it is eligible for a new set of deferments and forbearances. So Normally, deferments and forbearances have a 3-year limit, but that limit is per loan, not per borrower. So when you consolidate and get a new loan, it gets a new set of deferments and forbearances. So if you've been not paying your loans for a long time, in 3 years for the economic hardship deferment, 3 years for the unemployment deferment, and 3 years for forbearance, but you still are having trouble repaying the debt and you don't want an income-driven repayment plan, well, you can consolidate to reset the clock on these deferments and forbearances. So, and when the payment pause and interest waiver ends on September 30th of 2020, deferments and forbearances will be an option available to borrowers, as well as income-driven repayment plans. But if you previously had used up your deferments and forbearances, one option may be to consolidate your loans to get you a fresh set of those deferments and forbearances. But there are also several disadvantages of consolidation. So let's talk about why you shouldn't consolidate. One problem with consolidation is that it yields a single loan. So you can no longer target the loan with the highest interest rate for quicker repayment. Sometimes that will save you more money than having, even if you refinance, having a lower interest rate. There is a workaround. You could exclude that highest rate loan from the consolidation so that you can continue accelerating repayment of that loan. The weighted average interest rate, as I mentioned before, does not really change the cost of the loan, so it's not going to save you money. The only way to save money while remaining a federal loan is to choose a shorter repayment term that yields a higher monthly payment, which reduces the total interest you pay over the life of the loan. Public service loan forgiveness is based on the loan, not the borrower. Consolidation yields a new loan with a new time limit. So if you consolidate, you are going to lose all the progress that you made on loan forgiveness. Another reason not to consolidate is that it ends the grace period early. Your loan enters repayment soon after you consolidate. But many, the U.S. Department of Education and the Direct Loan Program will delay the execution of that consolidation, if you wish, until the end of the grace period. Or you could just wait yourself until the end of the grace period before you apply for a loan consolidation. It can take 30 to 60 days to consolidate your loan, so you want to start the process about a month before the end of your grace period. The federal Perkins loans loses a lot of benefits if you consolidate. They have a subsidized interest benefit where the government pays the interest during the in-school period and a 6-month and a 9-month grace period. You lose that if you consolidate the loans. It becomes effectively an unsubsidized loan. And there are many loan forgiveness options that are specific to the federal Perkins loan that you will lose if you consolidate. On the other hand, that can make the Perkins loan eligible for public service loan forgiveness. And the consolidation is a one-way process. You can't reverse it. So before you consolidate your loans, be very sure that this is what you want to do, because you will have no option to go back if you decide after the fact that it wasn't the right decision for you. And usually, borrowers who consolidate choose a longer repayment term, which means the total interest that you pay is going to be greater. The longer the repayment term, the more interest you pay total, because there's more time for the loan to charge interest. Now let's switch from consolidation to refinance. Why should you consider refinancing your loans? There are several advantages of refinancing. The interest rate on a private student loan is based on the current credit scores of the borrower, and if you have a cosigner, the cosigner's credit scores. It's the higher of the two credit scores. And if your credit scores or your cosigner's credit scores have improved, you may be able to get a lower interest rate on the refinance, and that can save you some money. Now, most private student loans do not allow you to change the repayment term on their loans, especially a fixed rate loan, without doing a refinance. You can't call up your lender and say, I'd like to go from a 5-year term to a 10-year term. They just won't let you do that because the interest rate that they're offering you is based on an assumption of that specific repayment term. But you can refinance your loans and get a different repayment term and obviously a different interest rate by on a home purchase or other credit. Having a longer repayment term is going to reduce your debt to income ratio, and that will make it easier for you to qualify. So there are a couple of options. You could pay off your loans faster if you choose a shorter repayment term, or you could reduce your monthly loan payment if you choose a longer repayment term. That's the kind of main trade-off that you face, as well as the difference in the amount of interest you pay. A private refinance is going to lead to a different loan servicer sometimes. Sometimes it's the same loan servicer. You're more likely to have a different loan servicer if the lender doesn't outsource their loan servicing to another lender. A lot do, but some don't. And changing your loan servicer, however, isn't necessarily going to make you happier. You may think that it's going to make you happier, but the quality of loan servicing is similar across most loan servicers. Some lenders may have a greater number of complaints, but that's usually because they service more loans. The complaint rates per 1,000 borrowers are similar, with one notable exception that is no longer involved in servicing student loans. That was a servicer known as ACS. They were heads and shoulders above all the other loan servicers in terms of complaints. Now, a refinance, like a consolidation loan, replaces multiple loans with a single loan, and that simplifies your repayment process. Now, maybe your lender doesn't have a cosigner release option. While refinancing can provide you with the equivalent of cosigner release if you refinance without the cosigner. The new loan, which doesn't have a cosigner, will pay off the old loans, which do have a cosigner, and that effectively releases the cosigner from the repayment obligation. But there are also disadvantages with refinance. So why shouldn't you refinance? Both refinancing and making extra payments on the loan with the highest interest rate can reduce the average interest rate on the loans and save you money, but you can't do both. So after you refinance, you'll have just one loan, not multiple loans, and that'll prevent you from accelerating repayment of the loan with the highest interest rate. Of course, one option is to keep that highest rate loan out of the refinance or to refinance it separately. Of course, in many cases, the interest rates on your refinance may be higher than the lowest interest rates that you're paying on some of your loans, and lower than the highest interest rate on some of your loans. So you need to compare the interest rate that you're offered on a refinance with all of the interest rates on the loans that you're going to include in that refinance, just to make sure that you really are going to have a lower average interest rate. Because if you exclude the highest interest rate loan, you may that may be where all the savings was on having a lower interest rate. So you need to do a little math to see if it's the right thing for you. Now, you also need to check whether that interest rate is higher, because your interest rate will be higher if you have a lower credit score than when you originally got the loans. So if you have bad credit or don't have a credit-worthy cosigner, you're going to get a higher interest rate. And sometimes you're going to get a higher interest rate without realizing it. You might compare the new interest rate with the highest interest rate on their loans, even though the new interest rate is higher than the average interest rate on all your loans, or just the lower interest rate loans. So what you need to do is calculate the weighted average of the interest rates on the loans excluding that highest rate loan and compare that to the interest rate that you're offered on the refinance. If the interest rate that you're offered on the refinance is lower, then you're going to save money. If it's higher, you might not. Now, the reason why you need to be very careful with refinancing federal loans into a private loan is that you're going to lose some of the superior benefits of the federal loan. So just what are these benefits? Okay. Well, right now there's a payment pause and interest waiver that runs through September 30th of 2020. You don't get that with private student loans. Private student loans are offering a 90-day COVID-19 forbearance, which doesn't include an interest waiver. Now that payment pause and interest waiver may get extended. It's currently under negotiation in Congress, whether it get extended at all, or Democrats want a year. Some Republicans want no extension. Some Republicans want an extension until the end of the year, some until the next tax day. Remains to be seen what's going to come out of Congress. Now, there are better deferments and forbearances on federal loans than on private loans. Federal loans have an economic hardship deferment and an unemployment deferment. These deferments are longer and their forbearances are longer than on private loans. For federal loans, it's up to 3 years. On private loans, it's typically up to 1 year in total duration. And the federal government pays the interest on subsidized loans during a deferment. Federal loans also have death and disability discharges if the borrower dies or becomes totally and permanently disabled. Federal Parent Plus loans are also discharged upon the death of the student on whose behalf the loan was borrowed, not just if the parent borrower dies. Now, recently, private student loans have added death and disability benefits. About 2/3 of private refinances offer a death discharge, and a little bit less than half offer a disability discharge. This is not as good as on new loans, where it's about 3/4 offer both death and disability discharges. Federal student loans also offer a whole bunch of other discharges, like a closed school discharge, identity theft discharge, false certification discharge, unpaid refund discharge, and so on. You don't get those with private student loans. Federal student loans offer income-driven repayment plans, where your monthly payment is based on a percentage of your discretionary income. Most private student loans do not. The only exception is Rhode Island state loans, which offer something like income-based repayment. Federal loans offer extended repayment as an option. Private student loans usually don't. They don't allow changes in repayment term on fixed rate loans other than through refi, though in some cases you might be able to get a change in the repayment term on a variable rate private student loan. There's public service loan forgiveness and teacher loan forgiveness and loan forgiveness for volunteering, military service, doctors, nurses, veterinarians, and public interest lawyers. You generally don't get that with private student loans. Sorry. Federal student loans are less expensive than private student loans. The federal government pays the interest on a subsidized loan during the in-school and grace periods and other periods of authorized deferment. You don't get that with private student loans. Federal loans have fixed interest rates that are generally lower than the lowest interest rate that you could get on a fixed rate private student loan. You might get a lower rate on a variable rate private student loan, but that interest rate has nowhere to go but up and will generally cost you more than that fixed rate on the federal loan. An additional benefit is you don't have to have excellent credit to get a lower interest rate on a federal loan. All borrowers of a federal loan get the same fixed interest rates regardless of their credit history. Interest rates on private student loans depend on the credit score of the borrower and the cosigner, if any. The interest capitalization, where interest that accumulates during a deferment or forbearance is added to the loan balance, has different frequencies with federal and private student loans. Accrued but unpaid interest on a federal loan is capitalized once at the end of the grace period, deferment period, or forbearance period. On private student loans, they can capitalize interest more frequently, sometimes as frequently as monthly, and that increases the cost of the loan. You have private student loans advertise very low interest rates, but most borrowers aren't going to get those low advertised rates. You have to have excellent credit with a FICO score in the 800s to qualify for that lowest interest rate. In some cases, the lenders are offering the low interest rate as kind of a loss leader. They know that just a few percent of the borrowers are going to qualify for that lowest interest rate. Most of the borrowers will actually qualify for the highest interest rate, not the lowest interest rate. There are other scenarios where a borrower may be able to get a lower interest rate, however, on a private refinance. That includes when you have older loans. New interest rates on a private refinance may be lower than the interest rates on older federal loans that were borrowed when interest rates were higher. And interest rates on federal loans several years ago were as high as 8.5%, much higher than the current interest rates on fixed rate private student loans, even the worst fixed rate private student loans. If you have excellent credit, you may be able to get a lower interest rate than on a private refinance than on a new federal plus loan. There's enough wiggle room there where the interest rates on federal plus loans are a little bit higher than what borrowers can get on a private student loan. For the federal direct Stafford loan, it's always cheaper than on a private student loan. And variable rates may be initially lower than the fixed rates on a federal loan. And if you expect that you're going to be able to pay off that debt in full, you're willing to do so and you are capable of doing so before the interest rates rise too much, you can save some money doing that. But does a refinance really save you money? Lenders have advertised that refinancing loans with them saves tens of thousands of dollars over the life of the loan. But is this really true? And in fact, some of these lenders have had to settle with the Federal Trade Commission, who argued that they were making false claims. Okay. Fixed rate loans are priced to yield the same net interest revenue to the lender as a variable rate loan over the same repayment term. In a rising interest rate environment, private lenders keep the repayment term short to keep their costs from rising too much. Keeping the repayment term short also lets the lender advertise a lower interest rate, since a shorter repayment term yields a lower fixed interest rate. But a shorter repayment term also increases the monthly payment, reducing the total interest paid over the life of the loan by having less time for interest to accrue. And most of that monthly payment is going to be applied to the principal balance of the loan, not the interest. So in this particular example, if you have an 8% rate on a 25-year term and you refinance at a 4% rate with a 7-year repayment term, you're going to significantly increase the monthly payment from $386 a month to $683 a month, but your total payments will decrease from $116,000 to $57,000. And that's a huge drop, saving you more than $58,000 in interest over the life of the loan. But if you were to change only the monthly payment without changing the interest rate, the total payments would decrease to almost $69,000. Okay, so that's higher than that $57,000, but not that much higher. So that yields a slightly lower savings of about $47,000. And the repayment term changes to 8.4 years from 25 years instead of 7 years. It takes you a little bit longer to pay it off. The savings from just changing the monthly payment is about 4/5 of the total savings. The savings from a lower interest rate is only about 12% of the total savings. The remaining 6% is due to synergistic effects, the interaction of the interest rate and the repayment term. Now, you can choose a shorter repayment term like this without refinancing your loan, just by making extra payments on your loan. There are no prepayment penalties on any student loan, so nothing stops you from making extra payments. You just have to be sure to tell your lender to apply the extra payments as the extra payments to the principal balance of the highest rate loan, not as an early payment of the next installment that's due. So a good rule of thumb is that if you cut the interest rate in half, you're going to yield about the same reduction in total payments as cutting the repayment term in half. Cutting the interest rate in half yields a lot less savings than most borrowers expect. On a 10-year term, the monthly payment decreases by only 10 to 20% when you cut the interest rate in half. On a 25-year term, it cuts the monthly payment by about a fifth to a third. So, and people think, cut my interest rate in half, cutting my payments in half. That's just not the case. It's a much smaller cut because most of your payment is going to the principal balance of the loan. So let's talk about how to go about consolidating federal loans. So this process has changed a little bit. It used to be going to studentloans.gov. Now it's going to studentaid.gov. They kind of merged all of their websites, and you log in there with your federal student aid ID, FSA ID, and you will complete the consolidation loan application and promissory note. There is an option if you tell them when your grace period ends, you can have an option to wait until the end of the grace period to consolidate the loans. So it's built in there. You need to provide your name, social security number, date of birth, permanent mailing address, telephone number, email address, driver's license information if you have a driver's license, employer's name, address, and telephone number as part of this process. And a lot of that is in case they send you a bill and it gets returned by the post office as addressee unknown, they have some options for trying to reach you besides just trying to contact your parents. And you need to provide 2 adult references, and they are people known you for at least 3 years. They are not co-signers. They're not responsible for repaying the debt. They're just, again, for skip tracing purposes in case you move without telling your loan servicer your new address. And you should keep a copy of everything, especially that confirmation email message that you receive, because if things get messed up, that will be able to prove the date that you applied for the consolidation. Now let's talk about how to refinance a student loan. Okay. Normally, you're entitled to 1 free credit report per year for a 12-month period from each of the major credit bureaus. You can do this for free at annualcreditreport.com. And those credit bureaus are Equifax, Experian, and TransUnion. And you should fix any errors in your credit reports by disputing them, because those errors can affect your credit score, which can affect the interest rates that you're offered on a private student loan, as well as whether you're even eligible for the private student loan. Now, it can take 30 days for the creditors to confirm the accuracy of the information. They can't confirm it, they must remove it from your credit history. So you may have to do this about a month before you are planning on applying for a private refinance. Okay. And in addition to your credit scores, of course, your eligibility for a private student loan will depend on your income, the percentage of your income that goes to repaying debt, the duration of employment, and a variety of other factors. You should calculate the total amount that you want to refinance, because some lenders have limits on how much debt they will refinance. And usually this is in the hundreds of thousands of dollars, but some have a lower aggregate limit. And you'll pick a lender. You should shop around, apply for multiple loans, because the advertised rates are not necessarily the rate you're going to get. There's no upfront pricing, so you have to actually apply for each loan to see the interest rate that you're going to get. You need to You don't need to worry too much about this affecting your credit score because, first of all, they now recognize shopping around behavior. So when you apply for 3 refinances, they don't think you're getting 3 separate loans, but rather one loan. And also these days, most lenders will use a soft inquiry on your initial application, so it will not affect your credit score. They'll do a hard inquiry when you consummate the loan, just to make sure that um, your credit report hasn't changed. And when you apply for refinance, if you apply with a cosigner, you may get a lower interest rate if your cosigner has a higher credit score. Now we've got a couple of calculators on savingforcollege.com that you might find helpful. The first is a refinancing calculator. You enter how much you're considering refinancing. This example involves $30,000 in debt at a 5% interest rate with a 10-year repayment term. And it has I entered a 4% rate with a 7-year repayment term. And it shows you before and after what it does to your total payments and to the number of payments and to your monthly payment, and suggests how much you're going to save on interest over the life of the loan, as well as how your monthly payment may change. The next calculator is a loan comparison calculator, which allows you to compare 2 or more loans. And this uses the same example of $30,000 in debt at 5%, but it compares it with 4% with a 5-year repayment term and 4.5% on a 7-year repayment term. And you'll notice that we highlight which one has the lowest monthly payment and which one has the lowest cost of the life of the loan. And so now we'll open it up to questions. We have a portal on savingforcollege.com/student-loans, which has our student loan content, links to our rating system, as well as to our calculators. We will be adding a ratings of student loan refinance opportunities within a month or so.
Awesome. Thanks a lot, Mark. And to everybody who submitted questions, thank you so much. For the rest of you, remember, if you have questions, keep submitting them. I'll go through the ones that we can. I'll also be sending out a poll while Mark is answering some questions, just so we can see how we can always make these webinars better. So Mark, first question. I think this one is pretty specific. Let's see if this one can stump you. Someone asked, my daughter is going to her 3rd year of law school. She took out a direct unsubsidized Stafford or Perkins, not sure the exact name, loan of about $20K her first year, another $20K her second year. She owes $10K for her last year, but she's living at home because, you know, the whole coronavirus and school's online. She's already has a job, and that's going to pay her $190K year 1 when she graduates in May 2021. What they're thinking of doing is taking out a federal loan of $50,000 to pay off the first 2 loans and her 3rd year loan, or her 3rd year amount that she needs to pay off. And then she's already making $30K from a summer associateship, so she should be able to pay off those loans quickly, even if she lives in New York. So what do you think about that?
Okay, well, what she's trying to do is get a lower interest rate, because federal loans, and the interest rate on a new undergraduate student loan is 2.75%. On a graduate student loan is 4.3%. And on the plus loan, which includes both the parent plus and the grad plus loan, is 5.3%. And those are at or near historic lows. So 2.75% is a historic low. So her federal loans from previous years are at higher interest rates. And so she could borrow more this year, even though she doesn't need to borrow as much. She can borrow up to the full cost of education, up to $20,500 as a federal direct Stafford loan, and the rest as a grad plus loan, and use that money, which she doesn't need to pay tuition, to pay off her loans from the last 2 years, thereby getting a new loan that has a lower interest rate. Certainly that will save her money, but given that her income is going to exceed her total debt, she may want to pay off her student loans quickly. And she might even be able to use a signing bonus or much of her first year salary just to pay off the debt entirely. But and certainly even 1 year saving on the interest rate is going to save her money.
Awesome. Yeah, so that was one question we had. Another one, I have defaulted on my private student loans years ago when I was unemployed. The account went to an attorney for collection. I've been paying that attorney every month. I want to get this loan back and pay someone else, like a credit union or somewhere where I can follow my account online, pay less, and see where I stand. What are my options?
Well, the main option is to get new debt that pays off the old debt. So you would contact the attorney and ask what your payoff balance is, and then get a loan and use that to pay off the old debt. Now, the default that was several years ago may still be on your credit history and it may affect your ability to get new debt. But maybe you have a family member, like maybe your parents are willing to get a home equity loan and provide that money to you to pay off your existing student loans, and then you would make the payments on that home equity loan. And it's a little risky for them because if you default on the home equity loan, they're either going to be stuck paying for it or they will, they'll lose the home. So that is a risky move. But maybe you can go to your local credit union or community bank and get a personal loan that you can use to pay off that debt.
Got it. Thank you for that, Mark. We just got one question, a little unique here. So someone says, can a foreign or domestic students that have graduated with non-Title IV student loans refinance to a private student loan in the US while working in the US as well?
There are some lenders that lend to international students in the US. I mean, several of them have been established in the last few years. So you might be able to refinance that loan with them. They will be especially interested in whether you have employment and what the likely duration of that employment will be. Are you here on an H-1B visa, and how long will that last? Or are you talking about OPT, which is a form of short-term employment, more of an experience for international students? That will play a factor. But we do have a list of these lenders on our website, and you can use that to go over to their websites and see what they offer.
Sounds good. We have another one asking, any recommendations for a one-stop shop for student loan refinancing? We get asked all the time for recommended lenders on refinancing.
Okay, so we are going to have an objective rating system. We already have it for undergraduate loans, graduate loans, and parent loans. We'll be releasing one for refinance soon. And that will show you all the information about these loans and an objective rating of the quality of the loan, taking into account the cost of the loan, the flexibility or eligibility, the customer service. It's a formulaic system that ranks them by that. And you can also just look at the information from the lenders and see that to compare them. There are a few companies that are kind of student loan marketplaces that will give you information about multiple lenders. Some of them will even do a kind of estimate of the interest rate that you may get using a soft credit inquiry to let you compare sort of actual rates that you might get on these loans. And we have information about all of this on our website.
Awesome. Thanks, Mark. I just started a poll, everyone. For those of you who are still around, would appreciate your feedback on how the webinar has been. But in the meantime, another question we have here, are remaining amounts on direct loans forgiven after 20 years on the IDR plan? With the remaining portion still subjected to tax?
Right. So income-based repayment has forgiveness of the remaining loan balance after 25 years in repayment. It's 20 years for pay-as-you-earn repayment, and in some cases for revised pay-as-you-earn repayment if you have only undergraduate loans. Under current law, that loan forgiveness is taxable. It's treated as though someone gave you money to pay off the remaining loan balance. Now, the IRS usually will let you paid back over time, up to 6 years, at a statutory interest rate. So it is going to be less debt than the education debt, because it's at the amount forgiven at your marginal tax rate, but it is still going to be a debt that you have to repay. Now, if you are in an income-driven repayment plan because you have low income, and your debts exceed your income, the IRS has options for forgiving or reducing the amount of debt, of tax debt, for people who are insolvent, where their total debts exceed their total assets. Usually it's best to have an accountant file these forms because they'll know how to do it correctly. But there are options, and we do have some information on our website that identifies the correct forms and what your options are. There's the option to make an offer in compromise to the IRS, where you can offer, instead of paying back the full amount, that you'll pay back a part of it. And again, it's a good idea to have an accountant or tax attorney file this form on your behalf, because they'll be able to advise you as to how much is going to be reasonable with the IRS and what the IRS is likely to accept. Sometimes they'll just reject it, sometimes they'll accept it.
Right. And Mark, just quickly going back to that law school question, the first thing to follow up on that. So you do think then that it is logical for what the daughter was planning to do, like take out the federal loans to pay those old loans to maximize or minimize rather the interest rate?
Yeah, I think it's going to, even if she just has those loans for a year before she pays them off with her high salary, um, it's going to save her money. But what she should do is create a spreadsheet where she lists the loan amounts, the current interest rates, and what those interest rates will be after she essentially uses new loans to pay off the old loans. And we have a loan calculator on our website that she can use to do those calculations. And that will tell her how much she will save if she keeps those loans for the full repayment term. And then she can also compare the interest rates and calculate what the total interest will be over a single year. And that'll show her how much she's going to save over just 1 year. And then she can figure out how much she's going to pay back, and whether she's going to pay off the loans in full as quickly as she can, or whether she's going to keep them around for a while and save her money and invest it. Personally, I don't like debt. I'd like to just get rid of debt as quickly as possible.
Very much agree with that statement. Okay, another question here. Where are some good places to, oh wait, sorry, we already asked that. Do you need to consolidate all of your federal loans into one direct loan in order to qualify for public service loan forgiveness? Or can you have several direct loans that can qualify for PSLF independently?
You can have multiple direct loans that qualify. You don't have to consolidate them. And the one reason why you consolidate is if you have loans in the old Federal Family Education Loan Program or Guaranteed Student Loan Program. Those loans aren't eligible, but if you consolidate them into a federal direct consolidation loan, they could become eligible. You probably shouldn't consolidate existing direct loans, because those loans may have been in repayment for different periods of time. And if you've been working in a public service qualifying job, they may get forgiven sooner than the others. And remember, public service loan forgiveness is per loan, not per borrower. So each loan, once you've made 120 qualifying payments on it, it can be forgiven. And so if you have one loan from, say, undergraduate school and another loan from graduate school, obviously the loans from undergraduate school will have been in repayment longer. And if you've been working a full-time public service job on those loans, and you may actually pay off and get the undergraduate loans forgiven before the graduate loans. I've seen people who have been in that exact situation. Whereas if you consolidate them, well, that's a new loan with a new payment counter. It's going to take you 120 payments on that loan, even if the original loans had some number of qualifying payments.
Got it. And then Mark, we have a lot of questions just regarding forgiveness. I just want to let participants know, first off, we're going to do a webinar on that next week, more details forthcoming. But for the ones that maybe can't make that webinar, generally, what do you suggest? So we have one question about teachers. Are there forgiveness options for them? And other people asking, you know, it's almost impossible to get loans forgiven. What do you recommend for someone trying to achieve that? Do you have like a general schmeal you could give to these questions?
So loan forgiveness is based on the occupation usually. And there are two main federal loan forgiveness programs, though there are over a dozen individual ones. There's a teacher loan forgiveness program for federal direct Stafford loans, where if you teach in a national need area and specific subjects, you can get up to $17,500 forgiven. And this is over a 5-year period. Public service loan forgiveness is after 10 years in repayment, and teaching does qualify for it. But maybe you're uncertain as to whether you're going to pursue teaching as a career. You might say, I'll stick it out for at least 5 years and then decide. Well, you can do both. I mean, obviously, you'd have to do the teacher loan forgiveness before the public service loan forgiveness, because the public service loan forgiveness eliminates all your debt. But you could do the teacher loan forgiveness, get that benefit, and if you decide to not continue with teaching, well, at least you got some forgiveness. Now, you can't use the same years of teaching service to qualify for both. So you'd be stacking them. 5 years of teacher loan forgiveness, followed by 10 years of public service loan forgiveness. In addition to all the federal loan forgiveness programs, there are about 8% of employers have what are called Lraps, or loan repayment assistance programs, where the employer gives you some money. Typically, it's about $100 a month towards repaying your student loans. And this year, from March 27th through the end of the year, that loan repayment assistance programs are tax-free. The hope is that Congress will make the tax-free status permanent. And if they do that, we may see as many as a third of employers offering these Lraps within a few years. And a lot of the employers say that they're waiting to see what the tax status will be.
Got it.
Now,
cool.
The second part of the question was almost impossible to qualify. Well, public service loan forgiveness has had just a few percent of borrowers who apply for it qualify for it. Now, sometimes this is because the borrower was in the wrong repayment plan, or they had FFELP loans instead of direct loans. But in many of the cases, the borrower hasn't been in repayment long enough. You can't make 120 qualifying payments in less than 10 years, because it's 12 months a year. 10 times 12 is 120. And a lot of the applications for public service loan forgiveness have involved borrowers who are a few years short. So they're not qualifying now, but they may qualify in the future if they continue to work in a public service job. But it isn't only the borrowers who have trouble counting the number of qualifying payments. The loan servicer has had problems counting the number of qualifying payments too. I've had several borrowers who I've personally helped who were told by the loan servicer that they had only 60 qualifying payments or 65 qualifying payments. And I was able to confirm that they had 120 qualifying payments, provided the documentation to the loan servicer re-investigated it, confirmed that they had made the qualifying number of qualifying payments, and then they got the loan forgiveness. And those extra payments that they had made, because you need to continue making payments until you get that loan forgiveness, well, they got those extra payments refunded to them. So you need to dot your I's and cross your T's and be very, very careful to make sure you're satisfying all the requirements. We have a checklist on our website, a full solid page of check boxes of things that you need to confirm to make sure that you're eligible. One of the ones that is kind of interesting is a borrower thought that they were in a qualifying job because they were working for the federal government, but in fact, they weren't working directly for the federal government. They were working for a government contractor, a for-profit government contractor. That contractor doesn't qualify for loan forgiveness. So you have to actually be working directly for a government agency to qualify.
Right, that makes sense. So we're about to hit time here. Just to conclude a little bit, this I'll let Mark said. So highlighting a few things. First off, we are in the process of releasing refinance rankings and review pages. Those should be up in the next couple of weeks. And to all those questions about, should I go with SoFi? Should I go with Discover? We're going to have some guidance for you guys on that. If you're part of our email list, you will get the communications whenever we do release those rankings, as well as other webinar invites, so you can keep coming back and asking Mark more questions. But beyond that, Mark, do you want to leave the audience with anything in particular?
Well, we take all the questions that we received, including the ones that I answered, and I am slowly going through these questions, and with many of them, I am writing new articles on our website that answer those questions. And they'll be in our newsletter, our student loan newsletter, so you definitely should subscribe to that. As well as if you want to see them more earlier, if you follow us on Twitter, you will, whenever we post a new article, we usually tweet it. And so that'll be a way to find out about all these new articles that we're writing on. And we've literally gotten hundreds and hundreds of questions about student loans over the last few webinars, and we're slowly getting through all those questions and writing new articles on those topics.
Awesome. Great. Thanks a lot, Mark. And thank you everybody for joining. Hope to see you at the next one.